Hello, welcome to LoanSense. Today's video is how much home can I afford? First of all, what is debt to income? Debt is your monthly debt payments. That's your minimum credit card debt, your car loan payment, your student loan payment, divided by your monthly income. Okay, that is the formula of debt to income. You have to have a low enough ratio so that once you add your mortgage note amount in, they call the back end ratio, which is your total debt to income after mortgage payment, is under 46%. That's the rule of thumb, okay? That's what debt to income is. So now, how does student loans impact that? When we went in the pandemic pause, a lot of loan officers and lenders were using Fannie Mae guidelines of 1%. That means if you held $100,000 of student loans, they would count $1,000 towards your debt to income. Well, if you have a relatively average income, let's say you earn $4,000 to $5,000 a month, and now they use $1,000, that's literally 20 to 25% of your monthly payment obligations is counted towards going to your student loans, which will disqualify you in many cases for home unless you're buying a $100,000 home, which in most markets that will not get you a home. So that $1,000 makes it cost prohibitive, not just to manage, but to buy a home. And they would count $1,000 in this deferment or forbearance pause. If you're in forbearance or this administrative forbearance, even if your payment was not theoretically $1,000 before the pandemic, but they're going by your actual balance, okay? Freddie and FHA count 0.5%, that's $500, which still makes it prohibitive for a lot of people. So what we do at LoanSense is we help people get into a plan based on their affordability or their income. And we help people use their actual payment. So instead of Fannie Mae $1,000 or even Freddie $500, if before the pandemic their income-driven repayment amount was $200, we help the consumer get their actual payment, especially when it's lower than the 0.5, assist with the paperwork so that the lender can show, let's say it's $200 instead of $1,000, right? Help you get that right documentation for close. Let's do this so that I can answer the XXX across the video from 50,000 all the way to 200,000. So at 50,000 with minimal student debt, you could afford at 7% interest rates with 3% down payment, you could afford about a $203,000 house. Now let's make it $60,000. I'm going to go up in 10,000 increment. You can afford a almost $44,000 house. Okay. At 70,000, it is about $284,000. We already did 80, so I'll skip that. Let's do 90. At 90,000, it's about $365,000. It jumped up a lot because we already did the 80,000. At $100,000 with minimal other debt impact, it's $406,000. Now I'm going to jump by 20,000 increments. At 120,000, you can afford about a $487,000 house. Of course, also the monthly payment is corresponded below, so you can see that. I'm going to now jump to $150,000 income. You can afford about a $609,000 house. Let's say you have $200,000 of income. You can afford about an $812,000 house. And let's say at about a $250,000 of income, how much house can you afford? That is a $1 million home, okay? Obviously, now let's talk about the impacts of student debt, because the point of this video isn't just to spiel off from a calculator, but let's say you are a high earning individual. This is a high amount of money, but to earn this amount of money, you went to school and accumulated $300,000 of student loan debt, okay? The impacts are pretty real in terms of what you could afford before and after. So before, with no student loans, the impact was over $1 million. Let's say you had $300,000 of student loans and the fully amortized payment of $3,452 would allow you to afford $641,000. If you now reduced your payment based on your income, your payment would be $1,800 for your student loan, and as a result would boost your home buying power by a whopping $177,900 plus dollars to $819,000. The reason I'm using high numbers is to show high numbers, as in high income and high student loan balance, is to show the impact of how managing said student loans really does matter to your affordability and how it could really tank your affordability. Like we saw at $250,000, it was almost 1.1 million. And it tanked the affordability just by having a student loan of a high balance, tanked the affordability by literally almost half. And by getting into the right plan, you could see it's boosted affordability to much, much, much closer to the original amount than if, 1.1 million down to 600. That's literally cutting affordability in half. And then by reducing the student loan payment, right sizing it to the amount the government says you can afford, gets literally a whopping almost 200,000 of extra affordability. The calculator, obviously, you can input things like, let's assume 250,000, 300,000 in student loans. Let's say there's a minimum credit card payment of $400 and a car payment of $500. Okay. Obviously, those additional debts impact the ultimate affordability. As you could see, it went from 610 to 544, and it went from 810 to 722. So the calculator can account for all other forms of debt. And again, it's the only calculator, it's the only available product and tool on the market that will account for the reduction in payment based on an income-driven repayment plan. I hope this video has been helpful. If it has been helpful, especially if you're a student loan borrower, please like, please subscribe, and please share. We cannot wait to come to you again with more episodes that can help you conquer your student loan debt and achieve whatever it is your financial goals and dreams may be.